expensive to be poor. Imagine you work at a minimum wage job. It's a struggle each month for you to make it from paycheck to paycheck. You don't have a bank account because banks have long ago abandoned your low-income neighborhood, and because you don't trust them. They charge punishingly high fees for minor mistakes. Without a bank account, it's hard for you to save your money. But not only that, you have to pay fees just to use your money. You are one of the 40 million unbanked Americans who spend 10% of your income on financial transactions. To put this in perspective, this is how much low-income Americans spend on food a year. Now imagine a different scenario. Like nearly half of the United States population, you have less than $500 in savings. With so little to save, you feel like you're always just treading water. This month, you stumble. Your car breaks down. You don't want to get evicted. You'll do whatever it takes to feed your kids, but you need $500 to fix your car. And you need a loan to recover from this financial setback. Where can you go? Even with a bank account, the underbanked have to rely on payday lenders and fringe lenders. These modern-day loan sharks charge interest rates of 300 to 2,000%. So you needed $500, but by the time you're all is said and done, you've spent $2,000 in interest and fees. And you've entered into a cycle of debt as you borrow from one lender to pay off another. Not only does this crushing interest make it hard for you to pay off these loans, it could ruin your credit and lead to your bankruptcy. You were looking for a lifesaver, but what you got was an anchor that submerged you into debt. Whose fault is this? Sometimes I hear people saying that the problem is financial education. But this assumes that the poor take out these loans frivolously and that there's another option that they could go to. But there is nowhere for them to turn. I'm a banking scholar, and I can tell you that banks are no longer interested in making small loans and taking small deposits. There's a disparity in the banking system today. There's a mainstream, regulated, federally subsidized banking sector that serves the middle class and the wealthy. And then there's a Wild West hodgepodge of unregulated lenders that serve the low income at very high costs. How did we get here? Over the last 30 years, there was a merger wave in the banking sector that completely transformed banking in this country. So America used to be dominated by a multitude of community banks, and today there are only about 5 or 6 that dominate. In other words, in about 30 years, Bailey's Bank lost to Potter's Bank, and then Potter's Bank got sucked up into Bank of America. Once the community banks left, and they left the low-income neighborhoods first, they created banking deserts. And as soon as these banking deserts were created, the payday lenders quickly filled this void. But even as community banks are dying, we're still stuck in this myth as a society that the answer is community banking. Every law enacted to address this gap has been about promoting community banking, but it hasn't worked. It's time for us to match the scale of this problem with a large solution. Other people are looking at financial technology, or fintech, some new innovation that will fix this problem. And tech will make banking cheaper and easier, and that will help. But as to core banking, which is saving and borrowing, technology is not the answer. Because banking requires trust. Trust is the currency of banking. Banks use other people's money to operate. And for this to work, you need trust. And historically, the only institution that can provide this trust has been the federal government. So while we can innovate around the details, this essential government-bank relationship hasn't changed in hundreds of years. In other words, when you want to save your money, you'd rather do it at a dusty old institution that's been around for 100 years than a nimble startup that might not be around in 10. So instead of just looking at the future for a fix for this problem, we might want to study the past to see what's worked. And it just so happens that there's a large, national, government-backed institution that already exists in every poor neighborhood: the United States Post Office. In fact, the post office was a bank for much of our history. The United States Post Office predates the Constitution, and it is not an overstatement to say that the post office built the foundation of our democracy. This is because the Postal Act of 1792, written by our founding fathers, made three crucial decisions. One is that the post office would be financially supported by the Treasury. It would be self-sustaining, but not profitable. Two, the post office would serve every community without regards to profits. And three, that Congress would subsidize the dissemination of newspapers by the post office. At the time, information was critical in participation in the democracy. And our forefathers decided that they would do this and not worry about the cost because the democracy was more important. Postal banking in the US was first proposed right after the Civil War by President Grant's Postmaster General. But as with any banking reform, a crisis is needed to get anything done. So it was after the Panic of 1907 that Teddy Roosevelt endorsed postal banking right away. But it wasn't until 1910 that we established the United States Postal Savings System with the help of President Taft and his Congress. Immediately, it was a success. By 1913, the New York Times called it self-sustaining, having received 32 million deposits in the span of 3 years, mostly from immigrants. And then the Great Depression hit. And as banks failed across the country, deposits flowed from the failing banks into the very safe postal banking system. Every year, starting in 1930 until 1933, postal banking deposits doubled. After the Great Depression, the postal banks were retooled to pay off the mounting depression debt. And then in 1940, they started selling defense savings stamps at the post office to help fund the war. At the end of World War II, the government had raised $8 billion through the postal savings stamps. And this was a time when Americans were saving a lot. One, because it was easy doing it at the post office, and also because they felt like they were fulfilling their patriotic duty. The peak deposit year for the postal banking system was in 1947, where there was $3.4 billion in deposits and 4 million users. But the sharp rise was followed by a swift decline. By 1950, community banks were everywhere, and they were offering more interest on deposits than postal banks. So those deposits left the postal banks and went into the community banks, which were now safe, being backed by deposit insurance. Note, however, that this would not be the case decades later, as those community banks would abandon each of those neighborhoods. So in 1966, President Johnson decides that the postal system is no longer necessary and it's abolished. The postal banking system died a quiet death and has since been forgotten. But we need to remember that postal banking was America's most successful experiment in financial inclusion. It created a culture of saving and provided safe banking at a crucial point in our history. In many ways, the banking landscape today more resembles that of 1910, when postal banking was initiated, than 1966, when it was abolished. So, what if the big new solution to our new problem is a really old one. Postal banking could eliminate banking deserts and leave no American unbanked. People trust the post office. We may see the post office as a dinosaur, but we don't suspect them of being a shark. And this stability and trust is crucial to promoting saving. Also, the post office never left low-income neighborhoods. In fact, 60% of post office locations are located in banking deserts. This is important because the unbanked and the underbanked still operate in cash, and so they need a physical location to save their money. This is not to say that they would have to remain in cash. Once you have a savings or checking account, you can use your debit card to start paying for your bills. Gone would be the days that you're spending 10% of your income on financial transactions. More importantly, a savings account can provide people a financial buffer for when times get hard. Imagine, again, that you need $500 this month, except now you can go to the post office, an institution that's not trying to gain maximum profits from your desperation. Perhaps you could get a loan for 10% interest as opposed to 300%. Today in America, the poor pay the most for credit and financial services. Indeed, the less money you have, the more you spend just to use it. Now, reasonable loans and savings will not cure poverty, but it will provide a much-needed lifeline instead of a crushing burden in the people's time of need. The post office is well-suited to do this because it's a trusted government institution. It helped build our country. It still manages to deliver mail to every household in the US daily. It has a branch in every neighborhood, and it has public service as its central mission. The post office is struggling to survive, and so are millions of low-income Americans. Postal banking could breathe life into both. This is what you call a win-win.